Hi everybody. I'm putting the video on for a while. As you can see, I'm on the farm in Aberdeenshire, so I'll have the video on for a little while. This is Gerry Celaya speaking, if you don't know me. And welcome to the Tricio, 3 investment ideas for a looming recession. John Calverley will be kicking off the first part of the talk, where he'll be laying out the case that we're trying to make about the US recession that's looming. And apologies from James. He's traveling today, so he won't be able to make it. John, over to you.
Great, thanks, Gerry. So the agenda today, I'm going to talk about the economy, particularly the US economy, really asking the question, is a US recession imminent? People have been talking about it for a long time. Is it now imminent? Does the banking crisis change things in any way? And then will inflation come down quickly? And then asking the question whether recession is good or bad for stocks. And then we'll pass it over to Gerry and he'll talk about some specific investment ideas. So I think looking at this tightening cycle that we're going through, first thing to realize is that it's been pretty fast and pretty aggressive this time. If you just look at the blue line here, which is the federal funds rate, we've come up almost 5 percentage points. And if you look back to previous tightening periods, 5 percentage points is pretty much at the high end of what often happens. But notice also the steepness of that blue line, much steeper than in most previous episodes. So this has been pretty fast, pretty aggressive, not too surprising given that inflation was up at 8-9% in the US and we started from such a low level. But nevertheless, Fed is definitely jumping on the economy here. And if we look at the Conference Board's leading indicator index, you can see that's pointing towards a recession. What I show here is the 6-month change. And in prior times, and going back a long time before this chart starts, in fact, you almost always get a recession when you see this. In fact, you always get a recession when you see this negative. You can also see that dip at the end there. That was the very latest figure. So it fell quite a lot, the very latest month. Now, historically, the time from turning negative to the start of a recession was varied between 5 months and 15 months. Well, it's now 11 months since it first turned negative. So in a way, we're getting really to the point where we should be seeing a recession. However, there's always some buts. There's always 2 hands with an economist. There are some different things going on this time, and this is one of them, the very high cash holdings that households have. What I've done here is looked at household deposits as a percent of GDP. And you can see it was pretty stable before COVID at around 60% of GDP. It jumped up in 2020, and that was driven, of course, by the checks that were mailed in the post to people in the US. There were 3 separate stimulus checks. Also by the fact that people simply couldn't spend because they were locked indoors or didn't want to go out to restaurants, etc. So it jumped up significantly. It's come down. But you can see there's still around about 8 to 10% of GDP excess deposits still compared to pre-COVID times. And that's about $1.5 to $2 trillion worth of cash that's there. So the spending of this, which obviously has been happening over the last year, is one reason why we haven't seen a recession already. That's helped to keep growth going. And we saw it again with the first quarter data, which just came out half an hour ago, showing very strong consumer spending. But there's still quite a lot of money there. If that carries on being spent, then it's difficult to get a recession in that environment. You've just got too much consumer spending. There are some reasons for thinking it won't all get spent. One is that lower income Americans seem to have already used up their cash. They, of course, got the stimulus checks. In many cases, they got unemployment benefit, which was very substantial, occasionally more than they were earning before. So they were able to increase their cash. They also paid down credit card debt. What we've seen over the last 18 months is that lower income Americans seem to have used up their cash and racked up their credit card debt again. So most of this excess cash is with higher income Americans, and they're more likely to consider their overall portfolio. And of course, that's down a bit, stocks and bonds down a bit from the peak. So I suspect that not all of this will be spent, and the pace of spending of it will probably tail off as we go through this year. So another thing that's keeping growth going is car sales. In fact, car sales were very strong in the first quarter of this year, as you can see from this chart. And in fact, that was one of the major factors in the Q1 GDP report just published. So what's going on here is that people couldn't buy cars during COVID, and last year as well. There was simply a shortage of new cars available. And even today, the more popular cars still have a waiting list. So normally in a recession, car sales go down. At the moment, they look like they could come up. And this is a big sector of the economy. So this is helping to avoid a recession so far and could continue to hold one off. But now we've had the banking crisis. We had 3 banks go down. There's another bank that's unlikely to exist beyond this weekend. In my opinion, that's First Republic Bank. There don't seem to be a huge number of other casualties coming for now, at least. But the result of this is that banks are changing their behavior. Now, this chart shows lending standards, and this in fact predates the banking crisis. So you can see they were already tightening standards, which is pretty typical in a period of rising interest rates. And we're expecting them to continue to tighten as they look again at their balance sheets in the wake of the banking crisis, and also given that many banks are now having to pay more to hold deposits, so they're having to raise deposit rates. And that changes the calculus as to how much to lend. So this, I think, is a negative factor for the economy, and especially if we get any more tremors, although I'm not really expecting more banking tremors, but if we did, that would make a recession very likely. As it is, I think this makes a recession more likely. But one of the things people are talking about is real estate prices and potential stress in the commercial real estate sector. And this is a chart showing the year-on-year changes in the various segments. Just if you look at the top right chart, which is the all property index, and you can see it's down 5%. But if you look at the pattern, which really applies to all of these charts, prices went down in 2020 initially, the effect of COVID, that got people worried. And then prices rose quite strongly in 21-22 year on year. Apartment prices up 25%, industrial prices up 25%, even central business district office buildings rose significantly in 2022, nearly 10%. But obviously they've all now fallen back, and there's quite a lot of stress in the commercial real estate sector. And some people are concerned about this, particularly because quite a lot of the lending is from regional banks and small banks. Although, having said that, not so much in the central business district, that tends to be the big banks. But there is some concern here that we could see a commercial real estate crisis sort of combining with banking crisis, making things a whole lot worse. So our view on this is summarized in the headline here. We think that bank caution is going to hit commercial real estate, but commercial real estate is not going to turn out to be a huge crisis for banks. So what that means in economic terms is that commercial real estate is going to be a drag on the economy, but it's not going to create a banking crisis. And obviously commercial real estate is under pressure. Rising interest rates are always going to do that. Usually financing is on a term basis, but when it comes due to be refinanced, it's going to have to be refinanced at higher rates. Banks are more cautious. We're seeing rents weak, particularly in big offices and retail. So as I say, well, I think we'll see distress in the commercial real estate sector. We'll see less building construction going forward, but not a systemic banking problem coming out of this. And one just footnote, the rest of the construction sector generally is quite strong, particularly infrastructure and even factory investment. And that's being driven by government programs. There's 3 big stimulus packages put in place over the last couple of years. The infrastructure bill, the CHIPS Act, which encourages firms to create semiconductor factories in the US, and the so-called Inflation Reduction Act, which has really nothing to do with inflation, except possibly to expand it, increase it. But what it does do is put a lot of money into infrastructure for green projects of various sorts, and really encourage that, whether it's wind or solar, electric vehicles, charging, etc., etc. So that the money there, we're talking several $1 trillion, on some count, close to $5 trillion over the next few years. So it's a very big stimulus. It's not all going to kick in straight away. A lot of it's going to happen a little bit down the road. But nevertheless, it means that construction sector generally is fairly strong. So let me just give you the bottom line on, is a recession imminent? I think it is. I think we will see one starting most likely before the end of the year. I think it'll be mild, but it will be definitely a recession, and it will see unemployment rise, and it will see a change in views on where the economy is. Let me turn to inflation, which is obviously the Fed's key concern. This is the personal consumer expenditure inflation rate, the one that the Federal Reserve follows most closely. You can see the headline number has come down quite a bit. It got up to about 7. It's now down to 5. The core number is not down so much, but it is down a little bit. If we look at the more recent figures and just look at the monthly change, which is the green bar, you can see that slight decline in the blue line. But the last 3 months of the monthly numbers have been quite strong. And it really is only coming down quite slowly. And so we have to look at the components of what's really driving inflation. And it's quite a mixed bag. So food prices are still up, 8.5% year on year, but energy prices are down. Meanwhile, used car prices are down. This one is one you've probably heard me talk about before. It's quite strange, really, that used cars become a sort of macroeconomic concern, but the price rose so strongly because there were no new cars, so people were buying used cars, drove up the price. And that was enough at one point to actually add more than 1 percentage point to inflation. And this decline you see year on year is enough to subtract 0.4% from inflation. But this, of course, is a transitory element, just like food and energy, in a sense. Used car prices will continue to go down, I think, over the next year or two, but they won't go down forever. So the Fed is going to sort of discount this, really, as an indicator of what's really going on with inflation. The same applies to shelter. Shelter is particularly rents, and it's up 8.2% year on year. But we know this figure is going to slow down considerably over the next year or so. And that's because we know that new rental contracts being signed right now are often being signed with a 0 increase in rent. So there was a big rise in rents after COVID, and now that's really slowing down. But it just takes time to feed into the consumer price numbers. So in time, this shelter price is going to go down all the way back down, probably to 1 or 2% at some point. But even if we exclude those 4 special elements, if you like, those 4 transitory things, everything else is up 5.1% year on year. And this is where the Fed is concerned, because that means that inflation is quite widespread. It's affecting a lot of sectors, particularly affecting the service sectors. And much of this is driven by wages. And that's really why the Fed is very focused on what's happening to wages. So let's have a look at that. This is the employment cost index, which is a quarterly number. We'll actually get the next one tomorrow. The light blue line is simply the annualized quarterly number, and the blue line is the year-on-year number. So blue line shows 5% year-on-year, which is quite a bit higher than it was pre-COVID, when it was just under 3%. The quarterly number, if we stay at sort of a 1% quarterly number, so about 4% annual, that's better, but still too strong. So we're running 1 to 2% higher than we should be, the way the Fed looks at this. And if we look at another indicator, this is the Atlanta Fed wage tracker. And what they do here is they actually look at census data for individuals, and they look at how their wages change from year to year. And you can see that's come off the top, but it's still growing 6%, whereas pre-COVID it was maybe 3.5, 4. So again, that suggests wages are growing about 2 percentage points too fast. So the question is, what's going to bring wage growth down? Well, we are seeing an easing in the pressure in the labor market. This is a chart from the National Federation of Independent Businesses, basically very small businesses, things like mom and pop restaurants and hairdressers, that kind of thing. And it's just asking them whether they plan to hire in the next year or not. And you can see it's come down. So there was a real peak, an unusually high number a year ago, and it's come back down to sort of normal, strong levels, but it has eased. And this is another indicator. It's the percentage of the employed who are quitting, presumably to get another job. They're not being fired, they're actually choosing to leave. And again, that was at a very high level. It's come down, still quite high, but that does suggest the labour market is easing a bit, that there's fewer jobs out there, and so people not moving quite so much. So I've said that I think there will be a recession, and I want to argue here why inflation will come down quite quickly, I think, in the US over the next year. So one thing I haven't talked about yet is profit margins, and they've been very high. They've started to come down. I think they'll come down more. But what we saw during the COVID period was that companies faced increase in costs, of course, but they were able to pass that on, and not just pass that on, they were also able to even raise prices even more. Not too surprising, because we had this real period of excess demand driven by the monetary stimulus, the fiscal stimulus, and then there was a shortage of supply in some areas. So, there were no discounts available, and everything was really running full tilt. So companies were making good money. And that's starting to change. And I think as we go into a recession, even a mild recession, margins will compress more, and that will help to bring down prices. And then I mentioned some of the transitory negative factors already. So I think all these factors, food, energy, used cars and rents, they'll all be negative, all turn negative over the next year. Energy and used cars are already negative. Food and rents, I think, will turn negative as well. Now, the Fed's going to look through this to some extent, but it does mean that both headline inflation and core inflation could show much lower prints by the end of the year. I think we'll be looking at 2 to 3% as the handles for these by the end of the year. So that's going to look like the Fed is really doing a good job. I also think that wages are going to respond quite flexibly in the US. That's typically the case, and we've seen that, we saw that in 2018, 2019, when the economy just slowed down a little bit before COVID, and wage growth came off the boil. I mentioned here, it says in the US, and there's a reason for that. I'm not quite so sure it's going to happen that easily in the UK or even in the Eurozone, and we could come back to that if you want in questions. So I think headline inflation is going to fall quickly. Core inflation will come down more slowly, but will still be coming down. Of course, the Fed will be discounting some of these transitory items, so it will still be concerned, and it'll be very much focusing on wages, which will come down with a bit of a lag. So there's going to be a bit of a lag there. So what does that mean for Fed policy? So we're thinking one more hike next week. That's what the market's expecting. We do too. But then likely pause. And I think what we're going to be looking for next week is what exactly do they say about that? Do they say they're pausing? Or what kind of narrative do they put around that? I suspect they'll want to keep the door open for further increases, but they'll probably make it fairly clear that they think they've likely done enough for now, but we'll see. Then I'm not expecting them to cut rates this year. I think they will wait and see what happens to wages. But then in 2024, I think as we see that recession develop, as we see prices come down and wages come down, then I think they'll be cutting interest rates. And we're probably going to go back to something like the 3% level over a year or so. So what does this mean for markets? And I'm going to talk a little bit about bonds and a little bit about stocks before I pass over to Gerry. I don't think it's any great surprise to you that bond yields usually fall during and immediately after recessions. That was true even in the 70s when they quite quickly started to go back up again, but they did fall in the immediate period after a recession. Apologies for this table, it's a little bit complicated, but there's some quite interesting things in here. If you to start with the left column, there's the various recessions we've seen. And the peak bond yield, this is the 10-year yield ahead of the recession. Obviously, in the 20th century, these numbers were quite high, 8%, 12.7%, 15.3%, 8.9%. And if you just look to the next column over, it shows the months before or after the recession starts that the peak happens. And this is where it gets interesting, because in the 20th century, the peak was after the recession started. So the markets waited until there was definitely a recession. And then they said, okay, the Fed's done it. They've caused a recession. That means inflation is going to slow, growth is going to slow. So now bond yields don't need to go any higher. They can start to go lower. But in the 21st century, you see that the peak in bond yields has always been before the recession starts. So the market's anticipating that the Fed will succeed, slowing the economy, causing a recession. And so you see that 14 months, 6 months, 15 months before. The peak we've seen recently, back last October, was about 420, 425. So it was about 7 months ago. If you look at the next column, it shows the change in the yield before or after the recession starts. Again, in the 20th century, yields went up in the first few months of recession. But in the 21st century, they've come down. They come down quite a bit before the recession starts. At the moment, we're about 80 basis points off the peak we saw last October. If you look at the next column, you can see that typically, even once the recession starts, bond yields come down further. And the final column just shows how many months until the yield low after the recession starts. And the point here is that it takes quite some time. It's a process that happens during the recession and after the recession, usually. Sorry about that, a bit complicated, perhaps too complicated for a webinar, but we'll make these slides available to you so you can see them. And then on stocks, again, probably no big surprise to you that stocks generally fall during recessions. May not be, well, it's probably visible from this that usually the trough is before the end of the recession, and that's something to bear in mind. Usually the markets anticipate the end of the recession before it actually happens and start to move up again. Not always, but usually. And a slightly less complicated table. So this is what happens to US stocks in recessions. And the first column is the peak to the peak of the stock market to the recession, how many months. Now, we've had a couple of times when it's been 13 months and a few other times where it's just been a couple of months. Well, it's now 16 months since we had the December 2021 peak. So that's quite a long time. And if you look at the next column, that shows what happens before the recession starts. So a couple of times there was quite a big fall, other times not much. We're down about 14% currently from the peak we saw last October. But then if you look at the final column, what happens during recessions, you normally see a significant decline in stock markets. It does vary. The biggest was 47% in 2008. We've got a few that are just sort of low double digits, 12, 13, 16. And we've got some that are a bit more. I would say this is based on monthly average data. If you actually looked at the real low, on closing low, or even intraday low, you're going to see much bigger numbers than this. But the reality is most people won't catch those anyway. But the message is that stocks usually fall during a recession. And my final slide, just to make the point that we have seen quite a significant fall in valuations already. This is the cyclically adjusted price earnings ratio. You can see how much it's fallen in the US. It was close to 40 times. Now it's just under 30 times. Now that's been driven by the fall in the market, but also by the inflation we've had. So the effect of the inflation of 10, 12% in the price level, that kind of cushions the fall in the market and lowers valuations. And we've seen a smaller fall in the Eurozone and a small fall in the UK as well. So on our view, in terms of value, stock markets are pretty much in the fair value area at the moment. But of course, if you get a recession, then typically earnings fall and people, of course, get concerned. There's always uncertainty in recessions. Even if it's a mild recession, there's going to be points there where people say, wait a minute, we're in recession. Is this going to get worse? And there could be bad news of some sort from the financial sector or elsewhere. which gets people nervous. So that's why stocks tend to fall. So with that, I'm going to pass over to Gerry.
Thank you, John. Now, I'm going to run through some slides showing you some of the ideas that we have. And then if you want, you can put your questions in the Q&A section. Is that all right, John?
Sure.
And we'll go ahead and answer them. I know we already have one question, which is, as John said, what about the UK when it comes to inflation expectations? All right, here we go with 3 ideas to help weather a recession. Our first one is bonds and tips. As John pointed out, bond yields usually go down during recession, so we expect that part of the market to do well. Relative outperformance and safety in key sectors like consumer staples is our second idea. As John said, the general market is stock market is expected to go down during a recession, so you try to find some places that may not go down as much and or hold up pretty well. And our final idea would be to look outside of the US, and we actually like the idea of Japan and the UK being able to weather a mild US recession. Next slide, please, John. Now, this is a yield chart, and so it's basically in yields, as you can tell. And this is the US 10-year Treasury note. And it goes back to just before the 2000s, so 1999. And you can see with the red arrows that during recessions, bond yields go down. It highlights what John said, and it shows us perfectly more or less where we are now. Yields have improved a lot since the 2020 lows. And there is a risk, obviously, that we're wrong and yields continue to rise, right? Inflation's up, Fed could do more, US economy could continue to expand, all those things could happen. But our view has been that between 4 and 4.5%, bond yields will probably peak, and those are good places to try to buy them. So on our view, even if the US doesn't have a huge recession, bond yields are probably not going to go to 5%, and you're probably going to see 3% at some stage. And if we're right about inflation dropping and John's other scenarios, we may see US bond yields consolidate well below 4%. I guess you couldn't rule out 2.5% at some stage as well. Next slide, please, John. Now, we talk about inflation-linked bonds in the US a lot. We don't talk about linkers in the UK that much because it's a bit of a special, it's a special problem, if you want to put it that way, in terms of what the market can and can't do, as the pension funds showed everybody at the end of 22 when PM Truss was in charge. However, in the US, it's a slightly different kettle of fish, and tips do offer you some decent real yield now, and then more importantly, they offer you some inflation protection. During recessions, they tend to do well, and in this case, you may or may not take the view that inflation is going to remain elevated above 2%, which should come through in better tip pricing, if you know what I mean. So you should get the real yield kick, as well as a little bit of bond protection in your portfolio, just in case we're wrong, and the recession in the US is a lot harder than we're expecting. Next slide, please, John. Now, let's look at stocks. Obviously, hindsight is really important to keep in mind, and we can all say that we love luxury shares. We were recommending LVMH since the company was founded, and look, it's gone up a lot. Of course, I'm not speaking the truth here, but it is one of those things to point out that luxury seems to be doing well. Luxury is all over the FT today, and I think yesterday, and it's one of those things where, quote unquote, it was obvious in hindsight that everybody wanted to spend $3,000 for a handbag. The red line is relative to the S&P 500 ETF, just to give some sort of realistic balance. And you can see you may want to put all your money into luxury stuff, but it's pretty expensive at the moment. And even though some people think luxury is recession-proof, and historically it's done pretty well during recessions, in other words, it's bounced back, this time may be different, right? Keywords to never go by, but it's worth pointing out. If you believe in luxury, you're paying a lot for it right now. Next slide, please, John. Places that we prefer would be really boring things like consumer staples. Now, keep in mind, consumer staples in the US is a mixed bag. You've got some things that I think all of us would agree are consumer staples, things like toothpaste, toiletries, things like that you need, and some of the shopping areas where people go to shop when they may be watching their budgets. However, it also does have tobacco shares. So if you are adverse to sin stocks or things that are basically inherently bad for you, then you may want to be careful about which ETF or fund manager you give your money to or clients' money to, on the view that consumer staples, you have to watch out what's in it sometimes. However, from a strict investment point of view, cigarettes are addictive. Consumer staples, it seems to be part of the index, and that's just the reality of it. During recessions, in the turn of the century, we saw it get hit hard. However, during the financial crisis, we saw consumer staples not do as badly as some of the other shares that are parts of the market. especially on a relative basis to the S&P. And during the COVID crisis, I mean, the shares didn't do great for a little while, but then they bounced back sharply. And right now they're not doing that well. They don't seem that expensive compared to this to the S&P 500. So it's one of those areas where we think it's gone up a lot, but really compared to the S&P 500, it's not as expensive as it has been in the past. Next slide, please, John. Healthcare. Again, it's one of those things that people spend money on even if they're in tough times. So you saw in the turn of the century, it didn't do great against S&P. During the great financial crisis, it did hold up pretty well, and it's done very well since then. We expect this area to continue to hold up, even if the US enters a mild recession or a medium-sized recession. So we'd be thinking that this sector will continue to outperform. Next slide, please, John. Utilities. Now, this is a bit of a puzzler because utilities are basically seen, or they used to be seen, as a yield play. So as yields went up, you used to think that utilities wouldn't do that well. And they have actually done pretty well, even as yields have gone up. So it's one of those things where you got to keep in mind, things change in the market. The reason people trade things, thematic reasons change. So at the moment, utilities are seen as being able to hold up, even though one, they're paying more for input, two, they're passing the prices on to consumers, and three, their margins haven't been crushed. So it's one of those things that you basically have to keep the lights on, even if you're going through a mild recession or a medium-term recession. So it's one of those things where people have to spend money on this. So it will probably do okay against S&P 500, and it'll probably do okay in a medium to maybe mild recession as well. So we'd be looking at utilities to do okay. Next slide, please, John. Now here's where it gets really strange. Mega cap. It's one of the things that's been running hot for the last few months since the start of the year. And everybody seems to be thinking that these companies can't go bust. Now, when we're talking about the US technology sector, XLK, we're talking about Microsoft and Apple, right? It's around 46, 47% of the index, of the sector index. So as long as you think Microsoft and Apple are going to do okay, then odds are this sector will continue to do okay. As you can see from the relative chart, the .com crash did not do the sector any good whatsoever, but it did all right on a relative basis during the financial crisis, and it's done very well compared to the S&P since then. So we would reluctantly say, yes, this sector is probably going to be doing okay during recession. As interest rates fall or expected to fall, people seem to flow money into the sector as well. It's like I said, it's a head scratcher, but it seems to be doing okay now, and it seems to be probably going to be doing okay in a recession. Next slide, please, John. NASDAQ 100, effectively it's the same thing, Microsoft and Apple, but here they only make up 25% of the index. But again, the same argument, which is people seem to be finding some sort of safety in mega cap, and that's what the NDX basically is. So the relative chart to the S&P is not as pretty as the XLK one was, but it's still quote unquote holding up. Next one, please, John. Now here's where it gets interesting. We like Japan. We've always liked Japan over the last, well, when I say always, the last 6 months, maybe 9 months. And it's one of those things where if you look at this chart with the data I've given you, you think we're near the top. If you go back to 1989, you'd say we actually have a long way to go before we get near the highs. But that's not really fair because our trading experience over the last 20 years, whatever, is that we are pretty much at lofty levels, and that has to be considered. However, compared to the S&P 500, this thing has underperformed for so long that we are fairly comfortable in saying that as long as Japan doesn't get sucked into some sort of worldwide huge drawdown in growth, but it's a mild US recession, which is weathered by the rest of the world, then this index probably holds up and could actually go a little higher. Next slide, please, John. And while we're looking around here in the UK, we like the UK markets. We especially like the FTSE 250 size, but we're not getting into that today. But even the UK FTSE 100, this is a total return chart, shows you that high dividend. And let's face it, most of them are either consumer staples or energy or tobacco or, Diageo, which is in the booze industry. Those are the sort of shares that we think will probably do all right. So therefore, we would expect the FTSE 100 not to drop, another 20% or so, but to probably just trade in a range and work its way higher. On a total return basis, the dividends will keep it chopping away at the upside. So we expect this to do okay over the next year, year and a half. Relative to the S&P 500, we would expect performance to hold up and maybe even slightly gain a bit. Even though all the headlines in the FT have been about how the FTSE 100 is horrible, we think they haven't taken into account the dividends and the fact that on a total return basis, it's actually not that bad. I believe that's the last slide, John, that I have. Yep, that's us. I know we're pressing on time here, so I'd just like to say, I'll put the video back on. I just have to say thank you for everybody for making it to our webinar. If you have any questions or follow-up comments, please feel free to email them to us. You know, James's, John, and my email addresses. They're on the website as well at info@tricios-advisors.com. Again, we have podcasts up on Spotify, so look for us there. The one on long bonds might be interesting to anybody who's considering or decided not to invest in bonds. It's one of those things where we discuss quite vigorously our view on yields and prices and what will happen with inflation. And again, on currencies, we talk about central banks over the next few weeks because we have so many meetings coming up, and they will be important, not just for currency traders, but for everybody else as well. We will be making the PDF of the presentation available to you, and we'll be sending them out. If you don't get it, please contact us and say, please send it to me over the next week. I know we have a bunch of holidays coming up, so everybody, we'll be around. We'll answer emails, and please feel free to contact us if you need us. And we're happy to be here to help. Thank you very much, everybody.
Thanks.
Thank you, John.